All right, folks, buckle up, because today we're diving headfirst into a stock market that's acting like it's allergic to good news. We're talking about a serious tumble, a real February frenzy, and it's all thanks to a double whammy. President Trump's tariff talk and Nvidia, yes, that Nvidia, taking an 8% nosedive. Is this just a bad day, or are we staring down the barrel of something much, much worse? Let's break it down. So what exactly happened? The S&P 500 got smacked, closing down 1.59%. The Nasdaq? Even worse, a nasty 2.78% drop, mostly thanks to Nvidia. And the Dow? Well, it wasn't spared either, shedding 193 points. We're talking about the worst week since September 2024 for both the S&P and the Nasdaq. Ouch. This isn't just a little dip. This is a full-blown plunge. Now let's talk tariffs. Trump, in his usual style, took to Truth Social to announce that those proposed tariffs on Mexico and Canada, a hefty 25%, are going live on March 4th. His reasoning? He claims they haven't done enough to stop the flow of drugs across the border. And if that wasn't enough, he's threatening China with another 10% tariff on top of the existing ones. This is playing with fire, folks, and the market is clearly feeling the heat. But here's where it gets really interesting. Nvidia. This AI juggernaut, the darling of Wall Street, fell even after crushing earnings estimates. They beat expectations on both revenue and profit, and their guidance was strong, fueled by the insatiable demand for AI. So what gives? Well, their gross margins declined, and their revenue beat, while still impressive, was the smallest in 2 years. This raises a serious question. Can Nvidia keep up this breakneck pace? Is this the beginning of the end of their incredible run? According to Jay Hatfield, CEO of Infrastructure Capital Advisors, we're stuck in a stalled, range-bound, slightly irrational market as we wait for policy clarity. Basically, nobody knows what's going on, and that's making everyone nervous. James Demert, Chief Investment Officer at Main Street Research, echoed this sentiment, saying that Nvidia's amazing earnings are hitting an extremely jittery stock market. And it's not just tariffs and Nvidia. We also got some concerning economic data. Jobless claims jumped to 242,000, a significant increase from the previous week and higher than expected. This is on top of other recent reports: weak consumer confidence, disappointing retail sales, and a generally pessimistic consumer sentiment, all painting a picture of a potentially softening economy. This is a recipe for disaster. Now everyone's holding their breath for Friday's Personal Consumption Expenditures Price Index, the Fed's favorite inflation gauge. This number could be the key to unlocking what the Fed will do next, and it could send the market soaring or plummeting even further. The stakes are incredibly high. With only 2 trading sessions left in February, all 3 major averages are on track to finish in the red. The S&P is down almost 3%, the Dow is down 2.9%, and the Nasdaq is getting hammered, down a whopping 5.5%. This is not how anyone wanted to start the year. Let's dive deeper into the tariff situation. These tariffs aren't just numbers on a page. They have real-world consequences. They increase the cost of goods for businesses, which can lead to higher prices for consumers. This can stifle economic growth and even lead to inflation. We've seen this movie before, and it never ends well. Now, some argue that tariffs can protect domestic industries and create jobs. But the evidence is mixed, and many economists believe that the long-term costs outweigh the benefits. Now, let's dissect Nvidia's situation. Their slight dip in gross margins suggests that competition is heating up in the AI chip market. Companies like AMD and Intel are nipping at their heels, and they're all vying for a piece of this incredibly lucrative pie. Nvidia's dominance isn't guaranteed, and they'll need to keep innovating to stay ahead. This is where Moore's Law comes into play. Moore's Law, the observation that the number of transistors on a microchip doubles about every 2 years, driving exponential growth in computing power, is becoming increasingly difficult and expensive to maintain. As chip manufacturing becomes more complex, Nvidia will face challenges in continuing to deliver the same level of performance improvements at the same cost. The jump in jobless claims is a red flag. It suggests that the labor market, which has been a pillar of strength for the U.S. economy, may be starting to weaken. This could be a sign that the Fed's interest rate hikes are finally starting to bite, slowing down economic activity. We need to keep a close eye on this number in the coming weeks. A continued increase in jobless claims could signal a recession. So, what should you do with all this uncertainty? First, don't panic. Market volatility is normal, and trying to time the market is a fool's errand. Instead, focus on building a diversified portfolio that can weather the storm. Consider investing in value stocks, which tend to be more resilient during economic downturns. And don't forget about bonds. which can provide a safe haven during periods of market turmoil. Now, some investors might be tempted to buy the dip, seeing this as an opportunity to scoop up cheap stocks. But be careful. Make sure you're investing in companies with strong fundamentals and a long-term growth potential. And always do your own research before making any investment decisions. Now, let's play devil's advocate. Some analysts argue that Trump's tariffs are a necessary tool to protect American businesses and workers. They believe that these tariffs will force other countries to negotiate fairer trade deals and level the playing field. They might point to the steel industry as an example, where tariffs have allegedly helped to revive domestic production. However, this argument ignores the broader economic consequences of tariffs, such as higher prices for consumers and retaliatory tariffs from other countries, which can hurt American exports. It's a complex issue with no easy answers. And what about Nvidia? Some argue that their long-term growth prospects are still incredibly bright, despite the recent dip. They point to the explosive growth of AI and the insatiable demand for Nvidia's chips. They believe that the company will continue to dominate the AI chip market for years to come. This argument relies on the assumption that Nvidia can maintain its technological lead and continue to innovate at a rapid pace. It also assumes that the AI market will continue to grow at its current rate, which is not guaranteed. Here's a crucial point. The health of the U.S. economy is a major factor in determining the future of the stock market. If the economy continues to weaken, corporate earnings will suffer, and stock prices will likely fall further. On the other hand, if the economy can avoid a recession, the stock market may be able to recover and even reach new highs. This is why it's so important to pay attention to economic indicators like GDP growth, inflation, and unemployment. The Federal Reserve's response to the current economic situation will also be critical. If the Fed decides to cut interest rates, that could provide a boost to the stock market. However, if the Fed remains hawkish and continues to raise rates, that could put further downward pressure on stock prices. The Fed's decisions will depend on their assessment of the economy and their mandate to control inflation and maintain full employment. So let's recap. The stock market is facing a perfect storm of negative factors: Trump's tariffs, Nvidia's stumble, and a weakening economy. This has created a high degree of uncertainty and volatility. While it's impossible to predict the future with certainty, it's clear that the stock market is facing some significant challenges. Now, where do we go from here? Well, that depends on a lot of factors, including Trump's trade policies, Nvidia's ability to innovate, and the Fed's monetary policy. But one thing is certain: the next few weeks will be crucial. My prediction? More volatility. We're likely to see continued swings in the market as investors react to the latest news and economic data. I expect the market to remain range-bound until we get more clarity on the trade situation and the economic outlook. In the long term, I believe that the stock market will eventually recover, but it may take some time. And remember, this is just my opinion. Always do your own research and consult with a financial advisor before making any investment decisions. What do you think? Is this just a temporary dip, or are we heading for a major correction? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more updates on the stock market and the latest tech news. Thanks for watching.